Well, hi there, everyone. Happy Tuesday after a long holiday weekend, and welcome to Chart This with Dave Keller. It's Tuesday, May 27th. Happy Memorial Day. Hope you guys were able to celebrate, recognize those who sacrificed so much for all of us, and hopefully enjoyed some family time. We stayed local here in Redmond, Washington, did some cooking out, did some hiking, went to a Sounders game, all the good stuff. But hope you're all doing well. My name is Dave Keller. I'm the founder of Market Misbehavior, and it's a pleasure to do this show with you every weekday after the close. Speaking of raging bull markets, certainly appears to be a bull market, at least for today. Last week, we're talking Wednesday, Thursday, Friday. Wednesday last week, we had that gap lower. Thursday and Friday, both sort of finishing in a position of weakness, certainly suggested a lot of question marks going into this week. Now, what's interesting is, of course, headline risk is the thing that will continue, I think, to affect this market to the downside and certainly to the upside. We get some social media comments from the administration saying, delaying tariffs with Europe, 50% tariffs, and as a result, market going kind of risk on today. Also, consumer confidence this morning came out, stronger than expected. So you've got. Again, I think consumer sentiment is very much tied to, tariff policy and other policy decisions. It is a whipsaw type of environment. So I feel like, to be honest with you, as you take a step back, it feels like the market is in disagreement. Sort of have upswings and downswings, all kind of netting out to neutral here over the last couple of weeks, and that really reflects the indecision we're seeing from the charts. Certainly speaks to a lack of clarity as to what the eventual realities will be with tariffs and what the impacts might be. We're all left to figure it out. So today, for one day only, the market taking it as a pretty positive development here. Let's take a look at the markets here. As if you've watched the show before, and I know many of you have, and I appreciate you doing so, tuning in live on LinkedIn, Facebook, YouTube, and X. We're going to show you the market averages today and what they did. We'll talk about some different asset classes. We'll look at a heat map that sort of allows us to look macro to micro, big picture, what the day was like for equities, and then focus on some granular individual ideas. Then we'll look at some charts to wrap things off, take a question or two. We'll call it an evening. It's gorgeous here in Redmond, Washington, by the way. Clear, high around 71 Fahrenheit. So as soon as this show is done, I will be putting on the hiking gear and heading out in the woods for a little while, clear my head a bit after a welcome back day. All right, let's look at the major averages. The S&P finishing over 2% higher, 2.1% to the upside. That's closing at 59.21 and change. The NASDAQ composite just below 19,200, and that's up 2.5% from Friday's close. The Dow up 1.8%. Mid caps, small caps, all up as well. This is a pretty decent uptrend day here. And again, after last week's sort of indecision going into the long holiday weekend, nice start to the week to be clear. And what we'll see from the chart of the S&P is, we've talked about that 5750 level, that shaded area we have on our chart of the S&P, which represents, I think the difference between a constructive market, which is holding the 200-day after breaking above it over the last month, versus a corrective market, which is failing to hold a key support level. Today, a nice bounce after Friday's test of the 200-day, no doubt. The VIX almost 3 full points lower, a little over than that. We're around 19 on the VIX. That's down from over 22 on Friday. So what happened last week is the VIX finally pushed above 20, which for us is a major warning sign, right? VIX over 20 is at least an elevated volatility environment, if not a high volatility environment. But if the VIX can get below 20 and stay there, this is a pretty decent bullish sign. So for the bulls, I would say the VIX doing what it did today and then remaining below there this week, especially as we get through some pretty significant earnings, specifically NVIDIA tomorrow. That would be a nice win for the bulls for sure. Looking at the bond markets, bonds actually rallied today along with stocks, so that's pushing rates lower. The 10-year yield finished today around 4.43. The long bond yield is back below 5%. We'll call it 4.94. So, again, lower rates. I have a chart of the 10-year yield, I think, that I grabbed for the chart review portion. Generally speaking, is this good or bad for stocks? The rates are coming down. I mean, in this particular situation, it would seem to me this is encouraging because basically lower rates tend to be better for companies, right? Better for stocks. Companies have to borrow money, particularly growing companies. And so if it's less expensive to borrow money, that's usually a good sign. And that's why eventually, as markets continue to grow and the economy thrives, rates start to drift higher, and eventually they get so high that it starts to have the opposite effect. But for now, I would say rates coming down is actually pretty encouraging. Gives an opportunity for the economy to expand here. When it's bad, when rates go down, that's when bonds are going up because of a kind of safe haven trade, right? Investors are buying risk-free debt and trying to ride things out. That's not the particular pattern you see today. You're seeing the TLT up 1.4%. You're seeing the dollar up 0.6%. You're seeing rates down. This is probably an encouraging sign, fitting in with the risk assets higher type of theme. Looking at the commodity space, I mean, one of the few places where you see a lot of red today is in commodities, right? So gold down 1.7%, silver, copper, crude oil prices all down, except for the natural gas ETF, ticker UNG. The rest of these commodity ETFs were in the red. And to be clear, I mean, crude oil, the chart of crude oil, potentially a double bottom, but still not a proven double bottom with a breakout above resistance. Gold and silver, I would argue, still pretty good charts. Pulling back still above ascending 50-day moving averages. We'll wait and see. Cryptocurrencies overall holding up pretty well here. And as you can see now, in the last 24 hours, Bitcoin did briefly go above 110,000. Currently trading around 109.5 and change, we'll call it. But that's, generally trending in the right direction. The chart of Bitcoin pretty encouraging in that it is at or near new all-time highs. Not a lot of charts can say that at the moment. Ethereum noteworthy, and then it's pushing above the 200-day moving average. That would be the ideal outcome here. So cryptos in general setting up for pretty good technical setup here. And I chart of Bitcoin overall fairly constructive here. All right, let's look at the 11 S&P sectors. We can see here all in the green. Consumer discretionary up 3%. That's your top performing sector. Technology number 2, up 2.4%. Those are two of the biggest S&P sectors, certainly two of the offense-oriented sectors, and two that are both up 2 to 3%, which is a pretty strong start to the week. Financials number 3, tied with industrials and materials. We'll call it a three-way tie for third place, all up 1.7, 1.8%. Financials are interesting. There are actually a lot of really encouraging charts in the financial sector. The yield curve has generally been steepening over the last 6 to 12 months. And that's certainly, usually going to help the financial sector, particularly banks, particularly regional banks. We've got some regional banks reporting earnings this week. I'm thinking like Bank of Montreal, CIBC are a couple that come to mind reporting earnings later this week. That might be Wednesday or Thursday. So some of the cyclical sectors doing well also. On the downside, the worst performing sectors were still up, just less than 1%. So you have utilities, energy, and consumer staples down at the bottom of the list. So on a risk-on day like this, I had a question from my one of my premium members over the weekend about beta as a measure of stock volatility and stock performance. And beta is basically a measure of kind of the relative volatility, right? So a beta of 1 means the S&P moves 1%, the stock moves about 1% as well, kind of similar to the benchmark. Beta over 1 means you tend to have bigger swings. A beta below 1, you tend to have lower swings or smaller swings. So the stuff that's at the bottom of the list are some of the lower beta sectors like utilities, like energy, like consumer staples, like healthcare. A lot of healthcare is kind of in that, like big pharmaceuticals would be in the low volatility bucket. So this is sort of a higher beta, higher risk, higher potential return offense. Those are the things that we're working today. As we continue on, the breadth really positive today. And again, last week, one of the key themes we hit on was the fact that the breadth was overwhelmingly negative as the week progressed, right? So as we got through Monday, Tuesday into Wednesday, all of a sudden the breadth took a really negative turn, and we had 90% down days on a day or two there on Wednesday, Thursday, Friday. Today, you get a 90% update for the S&P 500. 93% of the S&P members were up today, only 7% down. 86% of the New York Composite Index up. The Nasdaq Composite, which was the least constructive, still 2 out of every 3 Nasdaq names were up today. So this is a pretty nice, pretty certainly an encouraging start to the week. Now, how much of that? I mean, obviously, a lot of that based on the headlines over the weekend, and again, it's frightening. I would argue that the headline risk is so elevated, where one tweet or whatever we're going to call it from the president will have this sort of effect on the markets from one day to the next. But that is the hand which we are dealt here in 2025. And so, when it sounds like tariffs will be punted, will be delayed, will be less likely, the market is taking that as a big risk-on environment. Any sort of headline to the contrary is going to cause the markets to go back down, and that is, I think, what we're going to have to navigate here for the foreseeable future. So, as a result, I would say the volatility is pretty extreme, and the volatility in breadth indicators is very real, right? So last week you had almost every stock down on certain days. Today you have almost every stock up on certain days. And I think that is going to be the rule, not the exception, as they say. All right, looking at the Magnificent Seven stocks. Last week, there was no change in our market trend model, by the way, as we shared with our premium members over the weekend. Still bullish on all 3 timeframes for the S&P 500, no change. Tesla, the best performer of this bucket of stocks, up 7% today. The headlines over the weekend and again today about Elon Musk actually focusing on the companies he's running. So I guess that's good. And the market taking that with a positive reaction, up 7% today. NVIDIA up 3.2%. That's going into earnings tomorrow. Broadcom up 3%. Had broken below trendline support, but really more sideways consolidation. And today bouncing more toward the upper end of the range. On the downside, Netflix, the worst performer of the Mag 7 names, still up over 2%. So the story today, the biggest names driving higher, a lot of other things driving higher as well. I mean, this is a broad advance, but the strength in these names is really what's creating a nice upside gap for the major averages. All right, let's get to the heat map. As a reminder, this is the market carpet, as it's called on stock charts. This is a heat map style visualization. Huge fan of things like this, which allow you to go big picture to small picture or macro to micro. Look at the overall configuration of the market. What general impressions do you get? And then help you focus on some actionable ideas, outliers, themes, all of that I think appear on this heat map. Not a very diverse heat map today, right? And I would say generally this is a very strong day. You can see generally the further strength in the growth sectors, right? So here's technology in the upper left. Here's consumer discretionary, top middle. Here's communication services, bottom middle. I would say with technology in particular, I mean, pretty strong day. You have a couple names like FICO and VeriSign that were actually down today, but overall, these are charts that actually look quite good. Those are the outliers. The average chart looked very, very good. And note particularly the semiconductors, right? NVIDIA, of course, with earnings this week, but Applied Materials, AMD, these have not been particularly strong charts over the last 6 months, but coming off of the April low, a lot of these are starting to improve to the point where you might start to find yourself believing in the technical setups there. We grabbed a chart of the SMH to show you what's happening there. But I mean, overall encouraging. And I would say the fact that these charts are improving is a very good sign for the markets, right? Semiconductor sort of a bellwether group. That's a good sign about AI and all of those sorts of things, whether they can thrive through this period of potential tariffs and tariff uncertainty. I think that would be a very encouraging outcome if the answer is yes. Also noting in the lower left, by the way, not a growthy sector, but financials. And you're seeing a lot of green in this sector as well. Some of these charts like not Microsoft, MA is MasterCard now. And Visa, ticker V, both of those made new highs, pulled back a bit last week, but bouncing higher again today, which is pretty encouraging. At the top, AZO AutoZone. I actually think that's an earnings name this week, isn't that right? Let's take a look. Pretty sure. Today, there we go. That would explain maybe the movement today. AZO actually finishing at the 50-day moving average. This is actually the auto parts stores have actually been in really good configurations. A number of them have really started to improve. And charts like AZO have been a nice, consistent uptrend. Not a broken chart yet as we pull back to an ascending 50-day moving average. The RSI still holding above 40. That's all pretty good, but down 3.4% with today's earnings release. That's not great. But elsewhere within the consumer discretionary sector, a lot of green. Within the industrial sector, a pretty strong general up move. Not perfect, though. You have names like BA coming down. That's after making new highs last week, pushing above $200 a share. Within communication services, the two big ones, really the three big ones, if you add Netflix along with Alphabet and Meta, all up over 2%. That's pretty strong. You look outside of those names, a lot less strong, but then you're getting to like mobile providers, you're getting to like AT&T, old school telecom charts, and everything less constructive as sort of the internet-y part of communication services. What else stands out here? I mean, I would say generally, defensive sectors like consumer staples in the upper right, utilities, not bad. I mean, these were not sectors that were down today. They just weren't up as much as the growthy sector. So again, today's general theme, offense over defense. The two biggest growth sectors, technology and consumer discretionary, at the top of the list. And it shows when you look at the stock and group level, we have a lot of these stocks and groups having pretty strong uptrends. So anything down on a day like today, there's something company specific most likely happening there. This is an earnings miss. This is lowering guidance. There's not a lot of that happening, but there is some, and you can see that by the fact that the charts are not up when the average chart is definitely doing so. All right, we're going to continue on with the show here in a moment. As a reminder, I can see questions coming in already. One or two interesting ones that I want to answer, time permitting here. Any of the questions we don't get to, we'll put in the mailbag and get to them hopefully on Friday's episode. I do want to let you know, by the way, I was talking with George Noble over the weekend. George has agreed to come on the Market Misbehavior podcast in the next 2 weeks. I want to say 2 weeks out from today. I think I'm talking with George. George and I did not overlap at Fidelity. He was at Fidelity back in the day. George was Peter Lynch's first assistant, went on to be the first international portfolio manager in the early 1980s at Fidelity, ran the Fidelity Overseas Fund, did incredibly well, ended up launching a couple hedge funds, now runs a family office, and he is doing his first ever conference, an independent research conference, coming up Thursday, June 5th. Some really good presenters besides George, who's just quirky but incredibly knowledgeable investor. Jay Pulaski, who was, started the asset allocation team in Morgan Stanley early 90s. Michael Howell, who was the head of research at Salomon Brothers and ING Barings in London. John Roque, who I interviewed recently on my podcast. He's at 22V Research, but has had a great career in the hedge fund community in New York, working with Paul Tudor Jones and also the sell side. You can sign up for his upcoming conference. That's coming up on Thursday, June 5th. It's an all-day conference. It's virtual. You can get $100 off by using the code SAVE100, SAVE 100. I'll have the link in the description to sign up for the event. It's noble-capevents.com, noble-capevents.com. I'll put a link in the description or the comments where you can get to it on our YouTube channel. But George agreed to come on the podcast, and I told him I'm happy to share insights about his conference. The speaker list is pretty powerful, so check it out and definitely listen into my interview with George. It should be fascinating. Not an Elon Musk fan, if I remember correctly. So we'll see if we can avoid that one or just jump head into that topic when we talk on the podcast. All right, let's continue on here, looking at some charts, and we'll take a couple questions. We'll be good to go today. The S&P bouncing off the 200-day moving average. Going into the weekend last week, Friday was sort of a lighter volume day and a lighter move day, usually pretty quiet going into the weekend. However, plenty of news last week, particularly on Friday, caused quite a bit of fluctuation, a lower open, but a higher close, but right at the 200-day moving average. So I would tell you, having seen these sorts of charts for a while, I'd be amazed if you don't have at least some sort of bounce off of the 200 days. So many are expecting that. I am not the only market practitioner keying in on the 200-day moving average as a potential area of support. The question now is what's next, right? We're now bouncing off of the 200-day for today. That's good. Do we continue to see upside beyond these high sort of intermonth peak here in mid-May? pushing above 59.70. If so, that would be a very bullish follow through, a gap above the 200-day, a pullback to test the 200-day, and then a continued uptrend. That's about as bullish of a setup as I think you're going to find. If, however, we fail to hold this 200-day moving average, as we've reiterated, anything above 57.50, I think is a green light. I think that's good. And so days like today reinforce the fact that there's optimism out there. And certainly investors are optimistic for whatever reason. But I would also say so many are focusing on that as an area of potential support that if it doesn't hold, that's where things can get very ugly very, very quickly. So we continue to reinforce that, the value of that shaded area, value of the 200-day. The bounce we saw today is a good initial sign of a successful test of support. Does it hold? And again, I'm sort of laying out the chart of the S&P as a stoplight. I think that's a pretty good way of just sort of reflecting on the current, the current trend in the S&P. The fact that we sort of consolidated in this 5,500 to 5,750 range, and then we broke down, and that was a real negative sign. But recovering back into that range was encouraging. Breaking above that range was flat out bullish, and that's where we leads us to where we're at today with this chart. I think holding this level means we're in a constructive point of view. I think you want to have risk in your portfolio, or certainly I do. Below the 50-day moving average, I'm definitely going to start to hesitate and maybe take aggressive bets off and be more balanced. And then you're cautious below 5,500 when, there's a real possibility that we deteriorate quite further. So for now, I think watching that level is pretty vital. And again, what concerns me is, having seen this sort of chart happen before, a bounce off of support and then a break is such a classic breakdown pattern. That's why I think you want to stay focused on that, what we call a line in the sand. Now, breadth conditions had been deteriorating last week pretty consistently. Percent of stocks above their 200-day moving average broke below the 50% level on Thursday and then Friday. Today, just bouncing right back above there. So we're literally at a coin flip period. We're almost exactly at 50%, meaning half and half. 50% of the S&P are above their 200-day. 50% or below. I think this is the battle of the markets right now. And I think whichever way that this starts to, if we hold above 50% or if we hold below, I think that tells you about the general sentiment. For now, bouncing back above is not a bad thing. We got down to around 62% of stocks above their 50-day moving average. That bounced today back up to 73%. So a bunch of things that pulled back last week, bouncing higher today. The question is, does that sustain? Do we get a sustained break back above moving averages? And again, the problem I have with this market is we're one headline away from those numbers rotating right back to the downside. I don't have a solution for that. I think that is the volatility we're going to have to accept if you're investing in equities in 2025. I did want to point out, by the way, just a zoom in here on Chaikin money flow. This is an indicator I've grown to appreciate more and more over time. I'm not a huge fan of just looking at straight volume bars. This is the volume on the S&P 500 ETF every day. I'm just not a big fan of just looking at price volume and lining it up. I like indicators that are derived from volume that give you more of a sense of trend. On balance volume is one of those. Accumulation distribution line is another one of those. And then there's this one, which is the one that I tend to use, which is called the Chaikin money flow. Now, this weights the daily volume reading based on where we close relative to the highs and the lows. So if we're closing more at the highs of the day, as we did today, that's positive volume. If we're closing more at the lows of the day, as we did last Wednesday, that's more negative volume, because the distance from high to close is what Chaikin would call distribution volume. And the distance from the low to the close is what we call accumulation volume. And so looking at where we close relative to that range tells you something, or at least that's the logic behind this indicator. So it's worth noting that the indicator was basically sort of very bullish here going into the February peak, was noticeably neutral or choppy, kind of above and below zero in March and April, and then really turned back above the zero line at the end of April. And for the entirety of the month of May has remained in an accumulation range, meaning even though we've had some down days like we did last week on Wednesday, on Thursday, even though we had a gap lower last Friday, the volume, the distribution has not been enough to say that the volume has overall been more, selling of some sort. It's really more still signs of accumulation. The general trend in volume off of the April low has become more and more constructive. Now, the reason why I show that is because when the market's going higher on a bullish volume indicator, it's pretty straightforward. You kind of assume innocent until proven guilty. We assume that this is constructive until it breaks below zero. And that's where it tells you, okay, something's really starting to change and we're showing signs of distribution. Not there yet. Overall, still okay using the Chaikin money flow. The VIX today back below 20, and I think that's a pretty good sign. Last week, the VIX pushed back above 20. And for us, that's a warning level because the VIX over 20 means we're within the range where sell-offs can really start to occur. You really don't get significant breakdowns with the VIX below 20 because markets sell off when investors are getting nervous, when the investors are getting fearful, when there's uncertainty, and that causes the volatility to increase, and that causes the VIX to go up. So the VIX pushed above 20, which was a red flag last week. Let's say the red flag curled up and put back in its drawer for now. I am very much ready to pull that back out if and when we get the VIX back above 20. But for now, telling you, don't be so nervous. Market conditions are okay. Talk about rates. I mean, what's so interesting, if you take a step back on the chart of the 10-year, I mean, it's just, while we've had a lot of movement in the 10-year, right, from around 3.9% at the April low up to 4.8% at the beginning of this year, the 10-year really has been kind of choppy all over the place. Right now, we're about where we were at the February market peak, right? The S&P 500 is topping out here, where the 10-year yield's kind of in the 4.5%, 4.6% range. That's literally where we've been in the last week. So the 10-year, the bond market has been choppy, sideways, noisy, but not really directionally moving in a significant way. If anything, I would say rates are generally trending higher off of the April market low. We can see generally the yield curve has been steepening, with the gap between the 2-year and the 10-year point, or the 3-month and the 10-year point, generally positive. I mean, look at the trend in the 2s to 10 spread, which is basically looking at the steepness or flatness of the yield curve. It's been generally going from an inverted shape to more of a normal shape. And that implies a healthy functioning economy. For the record, it implies that there's optimism with rates higher down further end in the curve. When you have an inverted yield curve, it implies some pessimism about forward economic growth. So I would say rates kind of generally moving in the right direction for a little more optimism. We'll see. Today, bonds pushed higher while stocks and a lot of other risk assets pushed higher as well. Now, one area of the market that tends to be pretty closely related to interest rates is home builders, right? Home builders have not been a very good place to be. If you look at the relative performance of the ITB, which is one of the home builder ETFs that we track, it's been trending lower over the last 6 to 8 months. As it's, again, on an absolute basis, we can see a pretty consistent downtrend here. Now, the ITB did break back above its 50-day moving average, kind of came down and pushed slightly below. And so sort of an open question as to whether we will regain the 50-day moving average, sort of confirm a higher low last week, and sort of resume this uptrend. I would say rates continuing downwards would be a great tailwind to that trade. This group has not done particularly well because higher rates tend to make it more expensive to borrow money to buy a home, basically. So rates start to come down, bonds start to rally. That would be pretty good for the ITB. To be determined whether that chart is improving, but potentially showing signs of an upside rotation. One area where we've definitely seen an upside rotation, and it's been impressive, has been the semiconductor space. This is the SMH, which is a semiconductor ETF. You can see the rally off of the early April low. The gap above the 200-day moving average on Friday, we actually gapped down right to the 200-day. And today, pushing right back above here. So I think charts like the SMH holding their 200-day moving average, absolutely crucial. Because if charts like this can't hold the 200-day, there's no way the S&P and the NASDAQ, given the dominance of some of these semiconductor names, is likely to remain in a position of strength either. So semiconductors doing well is going to rely a lot on NVIDIA's earnings tomorrow, as in case we haven't made a big enough deal about the importance of that earnings release. Here's the chart of NVIDIA for the record. What's the technical setup going into earnings? Pretty strong. I would say the fact that, again, we've had this bottoming pattern, this higher low in the third week in April, rotating higher. We can draw a trend line. I probably could update that trend line, by the way. and just sort of continue it forward a little bit. This is one of those kind of easy charts. It's like, as long as we remain above this trend line, things just aren't that bad, right? So let's assume that that trend is going to continue until proven otherwise. So Nvidia making higher highs and higher lows above trend line support. As long as we hold that, I think that's good. We gapped above the 200-day. For now, we're holding that as well. The momentum is quite strong, sort of right around 68. So we're well above 50, showing, again, strong momentum, strong relative performance, strong trend. That's a good chart. Until proven otherwise, the chart of Nvidia is a good chart. And most of the Magnificent Seven started to look more and more like this as the month of May is almost done this week. We wrap this month and then go on to June as we continue through the second quarter. Tesla, I'll show you in a second here, because the chart overall pretty constructive here. Alphabet is pushing higher as well. Alphabet was on our minds last week because of the candle patterns. I'm showing a bar chart here, but imagine a candle chart. This is a shooting star candle that was flashed on Thursday. That's where we open, we trade higher, but we close back at the lows of the day. So the open and close are back at the lows. Little to no lower shadow, big long upper shadow. That's called a shooting star candle. Happened right as we tested the 200-day moving average. Friday was lower, which makes sense. Today pushing higher though, so potentially negating the shooting star candle. If we can get above the high of Thursday, that would complete a bullish rotation. So for now, Alphabet fighting this bearish candle pattern that we saw on Thursday after Friday's pullback. Today regaining the 200-day. Again, charts like this holding the 200-day pretty encouraging. That's after higher lows in late April and early May. All right, finally, Tesla. Tesla's a good chart. I would say Tesla, again, one of the others that, has made a higher low, has broken above the 200-day, has broken above the first Fibonacci resistance. That's at 318, 319. We broke above that. For now, we're holding that as well. Next upside objective based on Fibonacci retracements, at least, would be in the 380, 385-ish range. That's where that pink shaded area would be, not too far above today's close. We are getting to an overbought condition again. So one thing to look for here would be a higher price action on weaker RSI. If we would sell off tomorrow and we have higher highs on weaker momentum, that would be pretty negative. However, we can't assume that that's going to happen yet, because today's an active uptrend, right? So if we continue higher, this divergence won't play out. You'll actually see improving price and improving momentum. So let's see what happens. But for now, charts like Tesla, charts like Alphabet, charts like Nvidia, good charts and not bad charts. I can cite a lot of reasons why the market could or should or may go down. But for now, looking at the charts are fairly constructive. Let's assume that that's going to continue to play out here. All right, some great questions here. A number of comments on Bitcoin. I'm not gonna surface all of those, but I would tell you. I mean, I didn't look at the chart of Bitcoin. I did earlier. I just didn't. I meant to grab it for the show and I didn't. I mean, from a technical perspective, Bitcoin looks very good. Now, you could be, ask questions about, is this being manipulated? You had the Trump dinner last week and all of that. I mean, I think the reality is that things like, governments opening a strategic cryptocurrency reserve, that's bullish, right? I mean, if governments are acknowledging whether, however you judge the intentions of these particular policy changes, that sort of thing is going to suggest, further upside for Bitcoin. The bull case in Bitcoin, if you look at the history of Bitcoin, I'm going to share this because my daughter was asking me about this last week, and we had a little Bitcoin mini masterclass at the dinner table the one night. She was asking about what is Bitcoin actually? It was actually the first question I think she asked. So I was explaining blockchain, I was explaining the technology, I was explaining how it was, sort of the innovation of this decentralized exchange, et cetera, et cetera. But the reality is Bitcoin and other cryptocurrencies have gone through a series of phases, right? Last week, we had Bitcoin Pizza Day, where this poor guy basically bought 2 Papa John's pizzas with 10,000 Bitcoin that would now be worth over $1 billion at today's prices. But at the time, it was a relatively useless and definitely an impractical store of value. I mean, you really couldn't do much with it. Now you actually can, right? There are places where you can actually use Bitcoin to buy things. And if you look at your Fidelity account, Bitcoin's listed in there if you have it in certain wallets. And there's been Bitcoin ETFs, which was not the case for the longest time, which was a barrier to grow. So all those things have happened. Greater institutional adoption of Bitcoin, validation of this as not a sort of a pariah side show to the financial markets, but an actual legitimate asset class. A lot of those boxes have been checked for now. So overall, I mean, pretty encouraging. And from a technical perspective, the chart's going up. It's making new all-time highs, and that's by definition is pretty bullish. I would say from a technical perspective, clearing these highs and holding that breakout is incredibly important. Otherwise, this looks like a big retest of the previous all-time highs, and big major tops can happen when you fail to get above the previous resistance. Let's see what happens from here. Todd, thanks for watching on X. You said, any thoughts on JNK or HYG? Those are the high yield ETFs. Seems weirdly bullish given the headlines. Well, so here's the thing. In full disclosure, I do own HYG in one of my accounts. High yield bonds, I mean, honestly, when you're looking at junk bonds, they really trade more like stocks, right? I mean, if you don't think of these as much as corporate bonds, because these are pretty risky. These are the debt of risky companies, right? And so if you're buying high yield bonds, if you're making a play on junk bonds, you're basically assuming that companies, risky companies that aren't well established, are still in like an early growth phase, which is why their debt is rated so low, or their credit rating is so low. As a result, the potential payoffs tend to be better. High yield bonds doing what they're doing basically imply that that the conditions are good, and investors are not seeing a lot of likelihood that these companies will miss their debt payments. And there are a number of reasons why that could be, which is probably the subject of a whole webinar. Maybe I could find a good guest for the podcast that focuses on junk bonds. Mental note to do that. I'll see what I can come up with. But my point of this is the fact that the HYG, the JNK are both trending higher here, which basically means investors are seeing these as not as risky as they could. And again, the problem, or I guess one of the challenges, is because the market has rallied so well, because companies are arguably in a decent financial position, it's just the structure of the market has allowed it to where these junk bond issuers are less junky, right? The high yield debt is less risky. At least that's what the market is telling you. But generally, I tend to think of high yield bonds, the HYG, as an equity play. It's a different way of playing, of taking on risk. High yield bonds are risk. If you want a low risk thing, you go to AAA rated corporate bonds, or you go to treasury bonds or something like that, or TIPS or something which is a relatively low risk debt instrument. These are higher risk debt instruments. It's more like playing the risk in equities. Market's saying kind of risk on here. So we'll see. Last question, Akira-san, thanks for watching. And you said, sell in May and go away. In 2025, did the charts support this hypothesis? What did the charts indicate? Thanks for asking. I did a whole 1-hour webinar on this last week, and I hope many of you were able to attend. And if so, we sent out all the replay information last week. I hope you're able to enjoy that replay. The short answer is it depends, right? Sell in May over the last 5 years has not been a particularly successful strategy. And I'll show you the chart, one of the charts that we looked at during the event. This is the seasonality of the S&P 500. I'm looking at 2020 to 2024. So sort of post-COVID, or the COVID era, whatever you want to call this. This basically shows you the percent of time that May, June, July was a positive month. We can see that every May, or the last 5 years, has been a positive month. July has been a positive month 5 out of 5 times. June has been a positive month 4 out of 5 times. So the spring months have actually been quite strong. July has actually been one of the strongest months, and arguably with a combination of an average return of 4.4% for the last 5 years, and it's up 5 out of 5 times. May, June, July have actually been quite strong. Waiting for signs that the market is rotating lower, waiting for breakdowns, breaks of line in the sands, deterioration in momentum, deterioration in breadth, all the things that hopefully we will continue to follow here on Chart This. That's what can set you up for preparations for an eventual fall low. Sell in May and go away has really become more about the major low in the fall and less about an obvious peak in May. Look back at the last 5 years, the market has peaked out in the spring and the summer, but it's usually not been in May. It's usually been a little later, June, July, even August, and then the rollover into the fall months. So that would be my base case in 2025. We'll see how this plays out with exceptional headline risk, with earnings from companies like NVIDIA, so many other things to debrief on. We'll do our best to keep our eyes on the charts, to share some of the charts we feel are actionable or that you need to know to navigate these markets. I hope you find the show helpful, and I thank you guys so much for tuning in, and I appreciate you. For Market Misbehavior, I'm Dave Keller. Have a great night, and remember, it's always a good time to own good charts. Take care, folks.